Well, welcome back to Finance Uncut. On today's episode, a huge stock market crash. Well, Happy New Year's, everyone. I hope you all had a wonderful Christmas and New Year's celebrations. And as you can see, I'm still on holidays myself in some casual clothes. But I should be back in the office most days next week. So I'm not sure how many videos I'll do this week. But kicking off the year, huge stock market crash. Bit of a downer to begin the year. But anyway, let's have a look at this. But before we get to whether we're going to see a huge stock market crash, let's just cut to a clip with Robert Kiyosaki.
Speaking with you, Robert, to get your outlook, although I don't think it's a pretty one for 2022. You've been making headlines, everyone's covering it, where you're warning people, hey, folks, brace for a major market crash here.
Right.
What do you bring us this Christmas, Robert?
Well, the reason I love you guys is because I'm a hardcore gold, silver, and I'm Bitcoin and all this. I'm a hard asset guy. So it's good news for us, but it's bad news for the boomers. Very bad news. And what's happening is Jay Powell of the Fed is trying to push the yield curve up. But as most of you know, the real yield curve is the euro dollar curve. It's not the Fed curve. And the euro dollar curve went inverted. Now, every time that has happened, tragedy follows. So most of us are old enough to remember the last time that yield curve, not the last time, but an earlier time was 2007, the euro dollar yield curve inverted and the Fed was trying to hold it up. So the Fed's pushing it this way, but the euro dollar is going this way. And that led to the Lehman moment, 2008. So then what happened in 2019, it inverted again, the repo market inverted, the euro dollar inverted, and COVID appeared. So once again, the euro dollar yield curve inverted just recently. And I'm standing alongside my friend Jim Rickards that this next one is going to be the biggest of all. Now, it's good news for some people, but horrible news for the boomers who are starting to retire. So if you're a stock market person and you're counting on the stock market to keep you alive, let's say you're 65 years old and you're going to live to 85, you might be in serious trouble.
So Kiyosaki right there is talking about the euro dollar yield curve that inverted, and he's right. It does signal recessions. And here we have a look at the 10-year, let's see, 2-year yield curve, and you can see that's been heading down as well towards the back end of 2021. So we definitely need to keep an eye on this. And actually, if you have a look at the 27th of August 2019, where this yield curve did invert, and then only weeks later we had the blow up of the repo market, and then lo and behold, the cough. And so definitely keep an eye on this. And credit has historically led equities into bear markets. So here we've got the S&P 500 and high yield versus investment grade credit. And so yeah, the credit markets, the bond markets, definitely keep an eye on this. So if the Fed raises the short-term rates and those longer-term rates don't rise, and we see that yield curve tighten, that can just keep an eye on it. So when we have a look at the market, the Wilshire 5000 price index, and it's very clear that it does have nothing to do with the economy, the actual output of the economy. This is clearly a bubble, in my opinion. And when we look at the Buffett indicator, as of the end of December, 220%. I was saying this was a bubble when we're at 150%. So this thing has definitely gone a lot further than I ever expected. And the S&P 500 large cap index, bubble, not a bubble. Absolutely insane. And what is driving this? Well, we're going to come to that. So real market cap to GDP. This is a central bank bubble. This is what it ultimately is. And if there is a crash, if there is a return to its mean, we're looking at potential an 80% fall in the market. Am I expecting that? Well, I'll share that towards the end of this video. Falling margin debt growth from high levels triggers a sell. So if you have a look in that middle line, so that middle chart, that's the margin debt, the S&P 500 index in the blue at the top. So if we look at the margin debt in the middle there, the black line, go back to right on 2000 dot-com bubble, you can see a fall in margin debt, and vice versa. We see that fall in the S&P 500, and then pretty much the same thing in 2007, 2008. In fact, it's a very good correlation going all the way back to 1970. So if you have a look at that, feel free to pause this video at this point and have a good look at this. So the question is, where does margin debt go moving forward? And this gives us a little bit of a sneak peek. So margin debt has absolutely skyrocketed this year. And the question is, where does it go from here? And here's security brokers and dealers, margin accounts at brokers and dealers. And once again, you can see the growth in margin debt over the last, 30 odd years. But since 2020, bubble, clear bubble. This is a bubble in debt. We have a debt bubble. That debt bubble is driven by, well, I'll tell you what it's driven by in a sec. I think you guys all know where I'm going with this. And that is chasing assets. And once again, a lot of assets that have skyrocketed in the last 18 months or so, assets that have, they come in a certain amount of supply, right? And when you have buybacks, well, there's less supply of those assets. And so you've got more currency units, whether it's through margin or through a thing called central banks, putting liquidity into the market. We have inflation, or we have the inflation in asset prices. That's basically what I'm trying to say. And you can just see here the buybacks. And the question, though, is, and we're getting to it, if we see Fed tightening, so if we see less liquidity or liquidity completely turned off, if we see quantitative tightening, that's a whole nother thing. And interest rates rise, then buybacks will be at risk. And that's going to be one of the big drivers taken out of the market. One of the big drivers that has pumped this up is buybacks. That's very, very clear. And we look at the forward earnings revision, and it's not looking good for forward earnings, is it? So, this whole booming economy seems to be all short-lived. So, I've definitely shared videos that I think we're in a stagflationary environment, a high CPI, high inflation environment with a very weak, sick economy. If we need to have, the overnight and cash rates where they are from central banks, and we need this amount of quantitative easing done, we've got a very sick economy. And with the debt bubble that we've got and people's income stretched just to own a home, no one's got any disposable income left over to spend in the economy. And so the higher this debt bubble gets, the worse the actual underlying economy is. Because we've got a debt bubble chasing non-productive assets, where if we had debt going into productive assets, producing more goods and services, creating more productivity, then we don't get the inflation and we get actual wage increases. We get a very healthy economy, and GDP and output rises. But yeah, so this isn't looking good for the economy. And I'll share this chart before the S&P 500 real earnings yield. So have a look at the last time earnings yield went negative. Yeah, in fact, just towards the end of 2021, the S&P 500 closed at a 52-week high. 334 companies trading on the New York Stock Exchange hit a 52-week low, more than double the amount that marked new one-year highs. So where I'm going with this is that's only happened 3 other times in history. Guess when they happened? All 3 of them happened in December 1999. So there's certainly a lot of warning signs out there. The alarm bells are certainly ringing. So do I think we're going to see a huge stock market crash? Well, let me come to that soon. So here we've got investor sentiment and consumer confidence. Now, remember Bernanke in 2010, he said one of the reasons why we need to do quantitative easing is and accommodative policy towards that was to lift asset prices, which boosts consumer confidence. So this whole wealth effect. This is what the Keynesians are, big on. We just pump, get involved, intervention into the markets. We pump a debt bubble into assets, and assets rise. People will feel wealthier, so they'll spend more. Well, something's broken because consumer confidence is going in the other direction while investor sentiment is going up. But who are these investors that are so positive on the S&P 500? Well, I can tell you it's not the rich people, because the super wealthy are selling. So according to the Bloomberg Billionaire Index, the wealthiest Americans have unloaded $42.9 billion in stock this year through the start of December, which is more than $20.2 billion that they sold in all of 2020. So it's not the wealthiest. And this from Zero Hedge. Hedge funds are liquidating at a furious pace. Retail investors are buying it all. So, we're seeing also the options market. It's the retail investors that are pouring into options. So margin debt, options, all this leverage going into passive funds, which we'll come to. So the wealthy are exiting, the hedge funds are liquidating, and it's mum and pop and the kids that are buying it all. And one of the big beneficiaries of all this extra liquidity, this margin debt, options, whatever, has been going into passive funds. So you can see in this chart the growth that passive or index or ETF investing has been versus active. Now, it's sold as, you can't outbeat the market. It's got low fees, blah, 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 blah. However, I highly recommend, if you guys don't know who Mike Green is, now I disagree with Mike on a lot of things, especially our basic economics. But Mike, I listen to people I disagree with because, people are smart, people have got things that I'm missing, or people poke holes in my own thinking and I see where I make errors. So I listen to everybody on all sides of every debate, and I highly recommend people do that. A wise man once told me there's three sides to a coin: heads, tails, and the edge. And a wise man looks at all three sides, where a fool looks at one side and thinks he knows it all. So definitely recommend that. But one thing he says, and even the founder of Vanguard, John Bogle, said, is when passive funds get to 50% of market cap, then they no longer serve their purpose and they can become extremely dangerous. And Mike Green has done some real good work on this. Because remember, passive investing, you don't have a fund manager that's sitting there and going, well, I'll sit in cash here, I'll sit in some gold, now I'll buy this stock because it's undervalued, or buy this and I'll sell this. When you buy into a passive fund, they are just buying that index, whatever that index happens to be. So they're buying. So when you've got all this liquidity going in, all this capital going in, that is just buying. But when the selling starts, when you want to sell or take funds out of a passive fund, then all they do is sell. There's no cash sitting on the sidelines. They're selling. And if a lot of people are selling, then the selling just, there's potentially no floor there for the buyers if there's massive selling. Algos kick in, margin calls kick in. I mean, this could get very ugly on the downside. It's great on the upside, can get very ugly on the downside. And just best go and follow some of Mike Green's work on passive investing and the dangers of it. He does a much better job than I at explaining it. So what's driving this market? Well, it's central banks. It's quantitative easing. I've shared this chart before, major central bank assets versus S&P 500 index. And the correlation there, 97.2%. So as central banks in the last, 11, 12 years has done quantitative easing, which was supposed to only be once, remember? It was just QE. It wasn't QE 1, 2, 3, 4, infinity. It was just QE because it wasn't supposed to be a 1, 2, 3, 4, and 5 and so forth. And that has lowered interest rates. It's allowed companies to raise debt very cheaply to buy back their own stock. It's pushed people out the risk curve to get a return, because you can't get a return on bonds or you can't get a return on cash. So people have got to be pouring into the market. And then when you add on the margin debt, when you add on the leverage on top of that, it is no wonder. It is no surprise to see the market where it's at. This article from the New York Times entitled "The Fed's Moves Pumped Up Stocks. In 2022, it may pull the plug. Shares soared as interest rates stayed low and stimulus programs helped the economy, but expected changes could make investors wary." It's a pretty good article, which, I'd recommend you guys check out. So I'll put a link in the description below. So I've shared this chart before as well. So this shows the inflow of capital into equities in the last 12 months. And in the last 12 months, we've had over $1 trillion in the equity markets, which just in the last 12 months exceeds the last 19 years combined. So you got to ask the question, how sustainable is this? Can this continue to grow and continue to push up the stock market? That's a question everyone needs to ask themselves. And we have a look at this chart, thanks to Charlie Bolello. Since the GFC, have a look at this. Central banks doing quantitative easing. As I said, that then causes people to go up the risk curve. Companies are able to issue debt, buy back their own stock really cheap. We get the margin debt. We get so much leverage, so much capital goes into the stock market that since the GFC, only 2018 did we have a negative year in that year. And that's when we had the power pivot, because the market was like, oh, actually, we don't like this. And so here's my point. Can the market continue? Is the market going to crash? Can it continue going up? Well, I think it's all driven by central banks. So the key thing is to keep an eye on central banks. Yes, keep an eye on credit markets, but central banks play a big role in that. So this whole market, this big bull run that we've been in, and I talk to a lot of financial advisors who have never been in the industry prior to the GFC. In fact, they were in school when the GFC hit. And so, I hear them talk, and all they say is the market goes up, the market goes up, the market goes up. And we should be expecting, these sort of returns always. Well, I mean, if central banks continue doing what they're doing, quantitative easing at such a high rate and don't raise the overnight or cash rates, sure, I agree. The market can continue to go up, and it probably will in the short term. But this, in my mind, I have no doubts that this has been driven by central banks and debt pumping into asset prices, trying to get the Keynesian wealth effect happening to drive the economy. And it's failed. It's failed. And so the question is, where do we go from here? Where do we go from here? You can have a look at the 90s there. But we had tremendous growth in GDP and productivity. There was a lot of technological changes happening in there. Probably overcooked, and we had the dot-com bubble. But since the GFC, this has been central bank driven at the heart of everything. At the heart of everything. I don't believe we would have the buybacks without what central banks have done. I don't think we would see the margin debt if it wasn't for what central banks have done. I don't think we would see people going out the risk curve like they've done if it wasn't for what the central bank has done. And markets, I've shared this before, markets are predicting 3 Fed rate hikes this year, 96% chance. So, if they do, then yes, we're going to be in for some very, very interesting times. But to summarize this video before we finish off, in my opinion, the market has been driven by central bank policy. And as long as central banks continue this accommodative policy, then I believe the markets can continue to rise, or at least not crash. However, I guess to sum up, we need to watch the Fed taper. Okay. Now, while the Fed tapers, they're still buying assets. They're still putting bank reserves into the system. So that's more liquidity into the system. So even though the Fed may taper, they're still pumping more in. Okay, they're just pumping less in. So we need to watch for that. We need to watch for the Fed rate hikes, as I said. If the Fed raises hikes, if they taper, if they stop QE, if they try to tighten, so take those bank reserves out and sell bonds into the open market, then absolutely, I think asset prices are in big trouble. So stocks, bonds, real estate, I think they're in big trouble. I think the other thing we need to do is watch for the credit markets, the euro dollar and also the US yield curves. Have a look at that. So 2022 is a year to follow what central banks and what the credit markets are telling us very, very closely. But if this happens, here's the question is, how many rate hikes can central banks do before these markets do implode? And then if they do start imploding, do we see another power pivot? Do we see central banks go, sorry, and revert course and jump back into QE, cut interest rates? Do we see MMT? There's big push right now for universal basic income. not just in America, but across the Western world. UBI is becoming very popular. Media are even pushing it. And MMT is definitely, getting very, very popular. I can tell you here in Australia, in the Federal Liberal Party, which for my American friends, that's like the Republican Party. The Liberal Party have MPs who are supporters of MMT. I've spoken to them. I won't name who they are, but they are supporters of MMT. They have gone to lectures from, I can't remember the guy's name, but he's from the University of Newcastle. And apparently he's one of the founding fathers of MMT and a big proponent of it. And he's suckered a lot of ignorant liberal MPs into believing that this is the way to go. And so it's no wonder we're seeing here in Australia anyway, the Liberal Party, which claimed to be, the party of fiscal management and debt and deficits, and would blame Labor for raising debts. Yet you have a look at a chart and show the debt that's risen under this Liberal government, under the three prime ministers, and it's insane. So any type of Adam Smith style classical economists in the Liberal Party have died out. There definitely wasn't any Austrians. I don't think there was many Chicago Friedman types. I think maybe classical, maybe Keynesians. Well, a lot of them have moved to MMT now. So do we see a power pivot? Do we see universal basic income? Do we see MMT? Do we see this merger between, I guess, government and central banks? Do we see central bank digital currencies coming out? These are things to watch. So yes, I can see the arguments for a market crash, but I think things need to happen for that to happen, which I've outlined in this video. I can still see markets going up if things continue the way they are. But there is a lot of dangers out there. There's a lot of warning bells, a lot of alarms going off. But definitely keep an eye on debt as well. So that margin debt, keep an eye on that. So what do we want to do? We want to keep an eye on central banks. We want to keep an eye on credit markets, and we want to keep an eye on debt, especially margin debt. They're the things we want to keep an eye on to see where things are going, in my opinion. And yeah, so, but I just think people need to be very, very careful. We've got two choices where we're at. We're either going to see the destruction of the currency, or we're going to see a destruction of asset prices. We can't save both. We're at the point now with this debt bubble that we either save asset prices through destroying the currency, or we save the currency by destroying asset prices. So, but yeah, that's my opinion. Anyway, what do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. Really do appreciate it. Take care, everyone, and I'll see you again on another episode of Finance Uncut.